Hi, everyone. Welcome. My name is Jeff Greene. I'm a CPA and founder of MedTax, and we do proactive tax planning for doctors. And today, we're going to turn a complicated new tax law into hopefully some practical wins for physicians and medical practice owners. So the law that's driving today's changes is widely called the One Big Beautiful Bill Act, or OBBBA. Fun fact, the official title in the statute ended up different because of reconciliation rules, just like how the Tax Cuts and Jobs Act's name was handled in 2017. But in our world, you'll hear everyone say the Big Beautiful Bill. So that's what I'll use today. Here's the promise of today's session. By the end, you'll know which parts of the new law actually move the needle for W-2 employed doctors, for 1099 contractors, aka self-employed doctors, and for practice owners. You're going to see exactly where the 2025 rules create opportunities around equipment, real estate, entity structuring, compensation, state and local tax deductions, also known as SALT deductions, charitable giving, vehicles, and reporting. And you'll walk away with a clean action list that you can use same day. Quick disclaimer, I'm going to be giving you physician-specific education, not legal or tax advice for any exact situation. Medicine is nuanced, and so are your taxes. So use what you learn here as a blueprint to discuss with your CPA or with us here at MedTax. So let's start with a 60-second overview of what actually changed with this new bill. First, the bill makes the current individual brackets permanent after 2025. Those familiar 7 brackets topping out at 37% stay in place instead of expiring. That matters for long-term planning around Roth conversions, harvesting gains versus losses, and how you time large practice transactions. Second, standard deduction is larger in 2025, $31,500 for joint filers, $23,625 for heads of household, and $15,750 for single filing taxpayers. And these amounts are indexed thereafter. That single change reshuffles when it's worth itemizing for many physician families. Third, the SALT cap, the state and local tax deduction, is temporarily higher. For 2025, you can deduct up to $40,000 if you itemize as a married couple filing joint, with small annual increases through 2029, and then a scheduled return to the old cap in 2030. There's a phase out if your modified AGI gets high. I'll show you how to manage that cliff in a moment. Fourth is bonus depreciation. That is coming back with a vengeance, which a lot of people are very happy about. If you acquire qualifying business property after January 19th, 2025, you are back to 100% expensing. For medical equipment and many interior improvements, that is huge. It's one of the cleanest ways to lower this year's federal tax bill when you actually need care delivery assets anyway. Fifth is the qualified business income deduction, the QBI deduction under Section 199A. It's not expiring, which is also great. It's being made permanent with some tweaks to the limit mechanics and an inflation-adjusted minimum deduction starting after 2025. So for physicians, because medicine is a specified service, qualification for this QBI deduction still depends heavily on your taxable income. That means entity design, reasonable compensation, retirement contributions, and the timing of equipment or building projects all matter more this year, not less. Sixth is charitable giving rules. Those shift in 2026. Non-itemizers will get a modest cash gift deduction, and people who itemize will see a new 0.5% AGI floor. The translation for this is you'll likely bunch gifts or use donor-advised fund timing around 2025 versus 2026. Seventh, information reporting is starting to get a little bit friendlier, which is nice. Starting with payments made in 2026, the 1099 NEC threshold jumps from $600 to $2,000. So you're not going to have to issue as many 1099s going forward. Also, the third-party platform 1099K rules stabilize at the familiar $20,000 and over 200 transactions test, retroactive to 2022, actually. That's good housekeeping news for practices paying independent contractors. There's more under the hood. Car loan interest deductions for new U.S. assembled vehicles through 2028, a temporary senior deduction from age 65 to 69, and a variety of employer credits that will anchor to practice staffing. We'll hit the ones that are most actionable. Now, how do these changes play out for physicians? If you're W-2 employed, your biggest levers are SALT versus standard deduction optimization, charitable timing, HSA and FSA strategy, and if you receive overtime, there's a temporary deduction for qualified overtime pay available through 2028. If you're approaching or over 65, the new senior deduction can stack on top of your standard deduction for a few years. It's subject to phase outs, so we'll look at ways to manage modified AGI to keep that benefit. If you are a 1099 independent physician, your playbook adds the QBI deduction, retirement plan design, and the timing of major business purchases. Solo S Corp hospitalist with balanced W-2 reasonable compensation and net pass-through income often picks up a pretty meaningful QBI deduction if taxable income stays under the applicable thresholds. Making that happen in 2025 is part math and part calendar. And if you own a practice, this is the year to be deliberate. Equipment, leaseholds, and real estate are back on the center stage because 100% of bonus depreciation resets the timing in your favor for property you acquire after January 19th. Combined with Section 179's high ceiling, interest deductibility measured against EBITDA, and stable 199A, you can use the law to line up cash flow with rooftop level tax savings. So let's work through the big buckets. Equipment and build outs first. Imagine your group is adding ultrasound consoles, scopes, sterilizers, and a compact in-office imaging unit for a total of $900,000. Under the new rules, if those assets are acquired after January 19th and placed in service this year, you can expense 100% of the cost. That accelerates your deduction into the current return instead of stretching it over 5 or 7 years. If you finance the equipment, that's a real-time cash benefit because you're deducting before you fully pay. That's the essence of bonus depreciation, matching deduction timing to when it helps the most. Same idea applies to many interior improvements. If you're modernizing patient-facing space, reception, hallways, procedure rooms, the right improvements generally qualify as depreciable property that rides the bonus rules. Make sure your contractor and your tax team label and cost out the improvements correctly. Done right, you compare 100% bonus depreciation with a cost seg study, short for cost segregation, to accelerate what might otherwise be locked into long real property lives. Now, if you add Section 179 to that picture, the dollar limit increased to $2.5 million with a $4 million investment cap for tax years beginning after 2024. And then it inflates. Most physician practices aren't hitting the ceiling, but knowing it's there helps for bigger roll-ups or multi-site expansions. We typically lean on bonus depreciation first in 2025 because it's 100%, and then use Section 179 tactically for assets that bonus depreciation doesn't touch. Now to the QBI deduction. So medicine is what's considered a specified service, trade, or business. So your eligibility is sensitive to taxable income. The law makes 199A permanent and adjusts how the limits phase in with a new inflation-adjusted minimum deduction beginning after 2025. Two practical rules of thumb for this. First, your S-Corp salary should be truly reasonable based on market comps and RVUs, not engineered to zero. Second, layer in retirement and equipment timing to keep your taxable income under that applicable line. That combination, comp, retirement, depreciation, often decides whether a physician gets zero or a very large deduction. So let me give you a simple 1099 specialist example. Picture a cardiologist with $600,000 of net business income in an S Corp. She pays herself a market reasonable salary. She contributes aggressively to a defined benefit or a cash balance plan paired with a 401k profit share, and the depreciation from a modest 6-figure equipment purchase placed in service post January 19th, and the taxable income can land low enough to qualify for a meaningful QBI deduction. That law didn't change the fact that medicine is an SSTB, specified trade or service, but it did give us permanence and a little more room to plan the edges. And state and local tax and the standard deduction are where many high-income families in medicine leave money on the table. With the standard deduction of $31,500 for joint filers in 2025, plus the increased SALT cap for new users, your itemizing calculus changes a little bit. In a state like New Jersey, New York, California, or Illinois, property tax plus state income tax can now take you well past the standard, but the phase-out begins at $500,000 of modified AGI for joint filers. If your modified AGI will hover around that threshold, consider deferring income, increasing pre-tax contributions, or placing equipment in service this year to preserve more of that SALT benefit. And don't forget your state's pass-through entity SALT workaround if you own a practice. Those remain in play and can sidestep the federal cap. The SALT workaround, the PTE payments, are one of our favorite strategies to use because they don't cost you any extra money to implement them, and the savings have been tremendous up until this point. Charitable giving strategy shifts. Starting in 26, non-itemizers can deduct up to $1,000 of cash gifts or $2,000 for joint filers. Itemizers face a new floor equal to 0.5% of AGI. Only gifts above that floor are deductible. Practically, that pushes many physicians toward bunching or using a donor-advised fund in the on years and letting the standard deduction win in the off years. So if you have a large philanthropic goal, consider accelerating into 25 to use more favorable pre-26 rules. Okay, let's talk vehicles, because I know that question is coming. There are two distinct ideas here. First, for brand new personal use vehicles acquired via a post-24 loan, individuals can deduct up to $10,000 of interest paid through 2028, subject to phase-outs by modified AGI. That's an individual level rule and not a business depreciation play, but it may apply to you personally. Second, inside the practice, bonus depreciation is back to 100% for qualifying business use vehicles acquired after January 19th. If you're changing how an existing vehicle is used, be sure you understand basis, class life, and whether special rules keep you from bonus on a conversion. This is an area to coordinate closely with your CPA. And on that last point, some advisors are highlighting an approach for converting a personal vehicle to business use and leveraging 100% bonus depreciation based on fair market value and business use percentage. The mechanics include using the lower of fair market value or adjusted basis at conversion, no Section 179 on a converted asset, and being consistent across the asset class for your bonus election. It's a potentially powerful move for owners who truly use a vehicle in the business. It's not for everyone, and documentation has to be airtight on that, but it is on the table in 25. If you are over 65 in 2025 through 2028, the law adds a temporary extra deduction up to $6,000 per person on top of the standard deduction, with phase outs starting at $75,000 for singles and $150,000 for joint filers. Planning point here: if you are near the threshold, thoughtful timing of capital gains, Roth conversions, and business deductions can preserve that senior deduction. For employers, your practice, there are targeted credits and deductions worth knowing here. The employer credit for paid family and medical leave is now permanent. The employer-provided childcare credit is richer starting after 2025. And dependent care assistance benefits now exclude up to $7,500. Which is powerful for your team and a differentiator in hiring. If you've regarded these as HR trivia, 25 is your nudge to revisit them as part of your physician and staff retention strategy. And we have reporting cleanup. If you pay independent contractors, the 1099 NEC threshold rises to $2,000 beginning with payments in 2026. Many practices will issue fewer forms, but accuracy still matters here. For platform payments like patient refunds or side activity by third-party networks, the 1099K reporting remains at 20,000 plus, and over 200 transactions test retroactive to 22. This reduces noise, but don't confuse less reporting with less tax. Income is still income. One more for those of you buying or building a practice on credit. Interest deductibility is measured against EBITDA rather than EBIT starting after 2024. That improves interest deductions for leveraged acquisitions and growth investments because adding back depreciation and amortization before applying the 163J cap increases adjusted taxable income. That pairs really well with 100% bonus depreciation. You get the cash flow and the deduction timing. And for wealth transfer planning, the basic exclusion amount for estate and gift tax increases to a $15 million base for decedents dying in 2026 and later, and it's indexed thereafter. Many doctors won't hit this, but if you will, this is a window to revisit your gifting and trust design in coordination with your estate counsel. So let's bring these ideas together with a few quick physician-specific scenarios. First, the multi-specialty group adding diagnostics. The group acquires $800,000 of equipment after January 19th and places it in service before year end. Pair 100% bonus depreciation with a cost segregation study on interior improvements. Ensure Section 163J interest deductibility benefits are modeled at EBITDA, and run a comp and distribution model that preserves your QBI deduction for physician owners who can benefit. The net result is a large one-year deduction precisely when cash outlays are the highest, with distributions tuned to keep taxable income at QBI-friendly levels. Second, we have the 1099 proceduralist, reasonable S-corp salary informed by RVUs and market comps, a cash balance plan plus 401k profit share to reduce taxable income, the timed purchase of necessary scopes or imaging accessories placed in service post January 19th, and a SALT workaround election at the practice entity level. This stack can unlock QBI and a better SALT outcome simultaneously. Okay, number 3, we have the W-2 attending in a high tax state. Run the itemized versus standard analysis fresh for 25 with the new standard deduction and the higher SALT limit, and then plan charitable giving across 25 and 26 using bunching or a donor advised fund so that your gifts clear the new floor for next year. If you're 65 or older, you coordinate Roth conversions and capital gains to protect that senior deduction. Tremendous benefits when you stack these strategies together. Okay, number 4, vehicles. You genuinely need a business use vehicle in the practice and you acquire it after January 19th, you can leverage 100% bonus depreciation subject to the luxury auto rules for lighter vehicles and the special rules for heavy SUVs and trucks. If you're considering converting a personal vehicle used substantially in the practice, study the basis rules and the bonus eligibility carefully. Some owners may still find meaningful deductions, but documentation and facts are everything. Okay, number 5, people ops. Offer dependent care assistance up to the higher exclusion, revisit paid family and medical leave credits, and consider the enhanced employer child care credit after 25. In a tight labor market for MAs, nurses, and PAs, smart tax advantage benefits both reduce your practice's effective cost and improve retention. And while we're optimizing deductions, remember what's fading. Several consumer-facing green energy credits phase out or terminate sooner than expected. If you were banking on residential clean energy or EV credits personally, check the dates before you spend. On the business side, certain building efficiency deductions end for projects beginning construction after mid-2026. And timing matters here. Don't assume last year's incentives still exist because it's a totally new landscape that we're dealing with. Okay, let's turn this all into a short action plan that you can start right now. So first, map your 2025 tax picture early, forecast your taxable income, including practice distributions, and decide whether you're aiming for a QBI qualifying year. If yes, lock in reasonable compensation, retirement plan contributions, and the timing of equipment or improvement projects accordingly. The law gave us permanence and 100% bonus depreciation back. Take advantage of the certainty. Second, rerun your itemized versus standard analysis with the new standard deduction and the larger SALT cap. If you're near the SALT phase out threshold that we spoke about before. Use income timing and deductions to keep more of that benefit. Decide now whether you'll bunch charitable gifts into 2025 or into an on year under the new 26 rules. Third, clean up reporting. Update your vendor onboarding and AP processes to reflect the $2,000 1099 NEC threshold for payments beginning next year. And confirm you're squared away on 1099K understanding so you don't over or under report. Fourth, if you are 65 or older in this window, pencil out how the temporary senior deduction interacts with Roth conversions, asset sales, and charitable timing. Small shifts can preserve the deduction and improve after-tax cash flow. Fifth, if vehicles are part of your business reality, decide whether you'll acquire a qualifying business use vehicle post January 19th and how you'll document use. If you're exploring a conversion of a personal vehicle, get advice before you act so that basis, class life, and bonus eligibility are correct from day one. Sixth, if you're planning a building purchase or major renovation, align the construction timeline with the current incentives and the phase outs. You want to combine cost segregation with bonus depreciation to avoid leaving any deductions behind. So to wrap up, the big beautiful bill didn't rewrite the entire tax code. It did something more valuable for physicians. It really stabilized the most important moving parts and reopened a few doors that had been closing, particularly around bonus depreciation. So with the 100% bonus back for new assets, permanence for QBI, a larger standard deduction, and higher SALT cap for a few years, along with smarter reporting thresholds and new planning wrinkles for seniors, there's real money on the table for doctors who plan intentionally and proactively. So if you want this mapped out to your situation, your RVUs, your call schedule, your entity, your staffing, your upcoming equipment orders, just reach out. This is what we do all day at MedTax for physicians. Happy to take your call. Just go into the link in the description and book a free discovery call. Thanks for spending the time with me today, and here's to keeping more of what you earn while building the practice you want. Talk soon.